Let's quickly cover a topic, Jim, that you and I are both fascinated in. And it's the idea that central banks could go bust. And we've spoken before, actually, about the story where you confronted a central banker about this possibility. But what I want to dig into in this video is, what does it mean for investors if central banks are trading insolvent?
Well, as I mentioned, and forgive me if we're telling an old story, but I had a dinner, sat next to a member of the Federal Reserve Board of Governors, and I asked her that very question. And it has been true from time to time over the last 10 years. But basically, the Federal Reserve is a bank. I mean, it's called the Federal Reserve System, but there are 12 regional Federal Reserve banks. They may be they're actually privately owned. They're owned by commercial banks. They're directed from Washington by political appointees. So it's this kind of hybrid public-private system. But that aside, there is a consolidated balance sheet just rolling up these 12 regional banks, as I described. It's publicly available. You can go to the Fed website and find it. It's not some deep, dark secret. But they keep their balance sheet, and they have an income statement also, but they keep their balance sheet on an historic cost basis, which means that if they buy a bond at par and it yields, say 2%, say they buy a 10-year note at par and it yields 2%, and interest rates go up to 2.5%. Well, bond math 101 is, interest rates go up, prices go down, or interest rates go down, prices go up. So in that example where interest rates go up, which they have, the value of that bond went down. Now, but the Fed doesn't mark to market the way a hedge fund, but I kind of grew up in the hedge fund world, so I mark to market every day, sometimes intraday, but the central bank doesn't. So they're always going to have that bond at 100. So out here in secondary market trading, that bond's going to go down when interest rates go up. It'll go up a little when interest rates go down. But on the Fed books, it's always going to be 100 till it matures, and maturity could be 10 years from now. So what you're referring to, Nick, and there was an article in Reuters, and I read it, it was a good article, and someone said, well, interest rates have been going up and the Fed balance sheet is huge. It's still, kind of in the neighborhood of $7 trillion. They're trying to get it down, but with quantitative tightening, reducing the money supply, but that'll take years. But $7 trillion balance sheet, it doesn't take much of a rise in interest rates, and you mark those bonds down. And where does that come from in the accounting sense? What comes out of capital? So could you get to the point where your mark-to-market losses are so great that you've wiped out your capital, at which point you would say you're insolvent? That's what insolvency means. It's different than illiquid. The Fed's not illiquid. They can always print money, but they could be insolvent. So you have to do the math, but it's not that difficult. I've done it before. I haven't done it lately. But if someone said to me, well, on a mark-to-market basis, the Fed's insolvent, I would kind of shrug and say, yeah, maybe they are. The question is, does it matter? Do everyday Americans or everyday Australians, because this could be true of other central banks, the Reserve Bank of Australia and others, actually understand what we're saying? It's not that difficult. You can explain it to people, but people have lives. And, do they actually pay attention to it? Do they actually care? Probably not in most cases. It's a little bit of inside baseball. And then, as I said, what the central banker, no need to mention her name, but said to me was, well, first I said, you're insolvent on a mark-to-market basis. That was my opening. It was my gambit. She said, no, we're not. And I said, well, I think you are. And she said, no one's done that math. I said, well, I've done it and others have done it. And that's what we see. And then she harumphed a little bit and said, well, it doesn't matter. Central banks can't go broke. I mean, those were her exact words to me. So I was like, okay, well, that might be interesting to everyday Americans. That's what you think. So the point being, they think it doesn't matter. Most people probably don't care. But what the article you're referring to, what it was getting at was, okay, you're solvent on a historic cost basis. You might be insolvent on a mark-to-market basis, but you don't mark to market, so no one really knows. But what really matters is that you could have your cash flow could dry up, because what does the income statement look like? Well, the Fed makes money on these bonds. The Treasury pays them. You own the bond, you get paid by the Treasury. But what is the central bank paying? Well, they're not paying for cash. They print it, and I always say, $10 bill is a permanent non-interest bearing security of an occasionally insolvent bank. That's kind of what money is. But money is on the liability side of the balance sheet. But they have excess reserves, which are deposits from members of the Federal Reserve, which are the big banks, JP Morgan, Citi, and Goldman Sachs and others. And they pay a little bit of interest on those. So you're making interest on your bonds, you're paying interest on your excess reserves. But you get to a point where you've rolled over maturities and you're making less and less money on those bonds, but interest rates are going up. So you're paying more on the excess reserves, and you could actually have either negative cash flow or reduced cash flow. Yeah, that's possible. And what does the Fed do with their profits? They give it to the Treasury. They give it back to the Treasury. So, and then that helps offset the budget deficit. So this whole thing is connected. So at the margin, it could have a slightly negative impact on the budget deficit. The Fed could have negative cash flow. I don't know that they're there yet, but that's, it's an interesting possibility. But just to take the Fed side of the debate, we talked about marking to market the bonds, which are probably, or almost certainly, it's not a mystery, almost certainly worth less than what the Fed paid for them. By the way, everything we're talking about, you can apply in spades to the mortgage-backed securities. And that's a bigger problem. They're less liquid than treasuries, and mortgage rates have really been going up. So the value of those mortgage-backed securities that were originated at 2.5%, 2 7/8, 3.25%, when mortgages are now 5.5% in the US, that's really where the big loss has come in. But the Fed has a hidden asset. If you go to the balance sheet, go to the asset side, the first line item, there's something called gold certificate. And what is that? Well, in 1934, the US Treasury confiscated the Fed's gold. They'd already taken the gold from US citizens by that point, but they wanted it all. And so they took the Fed's gold, but under the but again, bear in mind, the Fed's privately owned. So under the Fifth Amendment of the US Constitution, it is illegal, it's unconstitutional to seize property without paying just compensation. You can do it, but you got to pay the person. And then people get into all kinds of arguments about what it's actually worth. So what just compensation did the Treasury give to the Fed when they took the Fed's gold in 1934? The answer is they gave them a gold certificate. It can be, you can calculate it. In other words, you can say, well, what is the amount of gold by weight, not by dollar value, but by weight that is needed to back up that certificate given the historic cost? So the answer is about 8,000 tons. Guess how much gold the Treasury has? About 8,000 tons. I mean, one of the reasons I've hypothesized that the Treasury stopped selling gold in 1980, because they lost gold to trading partners between 1950 and 1970. They lost 11,000 tons. They went from 20 to 9, but they sold another 1,000 tons in the 1970s to suppress the price of gold, which failed because it always does. But by 1980, they had were down to 8,000 tons, and they stopped. Why did the U.S. stop selling gold? We've never sold any significant amount of gold since. The answer is, in my view, is that they can't go below that, because that's the amount of gold the Treasury needs to back up this gold certificate on the Fed's books. So, okay, just kind of put that to one side. That asset is valued on the Fed's balance sheet at $42.22 an ounce. The price of gold, look today, it was about $1,850 an ounce. Now, so, what's, as I say, sauce for the goose is sauce for the gander. If we're going to mark the mortgages to market in a world where interest rates have gone up and the mortgages have gone down, it's only fair to mark the gold to market. And if you mark that gold to market at $1,850 an ounce versus $42, voila, you would find that the Fed has another approximately $350 billion of hidden assets. So I think that takes care of the solvency problem. So before we beat up the Fed on mark to market on mortgages, that's fine, but have a look at the gold and realize that they have a hidden asset, a shadow asset on their books that's worth in the hundreds of billions of dollars.
But the US government would lose that value then in that exchange, right? Because
they wouldn't lose the value. Because
it's still sitting there. Yeah. I guess it was never theirs.
Yeah, they have the gold, and the Fed has a certificate. None of that would change. I'm just saying, if you want to play the if you want to play the mark to market game, which the Fed doesn't, but if you did, you can't just attack the securities, which is fair game, but you have to give them credit for the gold. But maybe the real bottom line on that, Nick, is that everyone pretends we don't, that gold's not a monetary asset. We're not on a gold standard. Maybe we really are. They just don't want to admit it.
Jim, you've literally just stolen the monthly issue of my UK gold newsletter there. You've stolen my thunder. But quickly, something to mention about this is that right now they're sitting on unrealized losses. But under QT, those losses would become realized, which is when this starts to really matter. So you can pretend all you like, but if you start to sell the bonds, well, you can only sell them for the market price, not for the par price. And so then potentially the losses start to mount. It's also worth noting that in the UK specifically, I don't know how familiar you are with this, the government gave the Bank of England an indemnity on losses under the QE program. So the connection between the Bank of England's losses that we've been speaking about on bonds and the government's budget is much more clear. And there's some politicians trying to investigate that and find out what that could amount to. But there's this hidden angle, basically, is what we're trying to say on QT, that losses might become realized at central banks. What do you think would do the gold? Go ahead. Sorry, Jim.
I was going to say, we do things differently in the United States. Instead of the government guaranteeing the Fed's guaranteeing the government. So.
What do you think it would do to the gold price if they did revalue mark to market their gold holdings? Do you think that would create a lot of attention for gold and people would pile in, or do you think it would just be an accounting change that no one really notices?
I think it would be a very big deal. But it begs the question, if you're going to revalue it, to what level do you revalue it? So everyone said, well, the market's 1850, that's about where it is today. It goes up and down, but so revalue it at 1850. That could be highly deflationary. And the reason is, in effect, you're putting yourself on a gold standard. You don't have to. That's why they won't do it. They don't want to touch it. But if you did, you would be saying, hey, gold's really worth 1850 and we have this much gold, et cetera. But at that point, analysts would sort of turn and say, well, okay, well, you're back to a kind of gold standard. What's the relationship between gold and money or currency or US dollars and others, the money supply? But what is the relationship between gold and money supply? What you would find is that at 1850, the gold relative to the money supply is about 2%. Whereas historic gold standards were run with somewhere between 20 and 40%. Bank of England in the 19th century managed a successful gold standard between the Congress of Vienna and World War I with about 20% gold. In the US, through most of the 20th century, at least the first half, ran a gold standard with about 40% backing. It was actually the law. The law until the late 1960s, I think 1968, was that the Fed money supply, base money, could not be more than 2.5 times the value of gold. Originally at $20 an ounce, $20.67 an ounce, later $35 an ounce. But whatever that number was, times the amount of gold, that had to be 40% of the money supply, and the money supply could not be greater than that. And then they got rid of that in 1968 because of the war in Vietnam. But the point being, 20% has worked, 40% definitely works. The Austrians like to bang the table and insist on 100%, but maybe, but that's historically not been required. You just need enough gold to be able to give gold to people who want it when they want it. And if you're credible in that dimension, most people are content to hold the money. So as a hypothetical, you can say, well, okay, let's say we want a gold standard, and let's say that we want 40% backing of M1. M2 is a bigger number, or at least it can be. Let's just say, so 40% backing of M1, that's a conservative kind of gold standard, not extreme, but reasonable. What would given the amount of gold the United States has, what would the price of gold have to be in order to maintain that ratio? The answer is about $15,000 an ounce. And people say, well, Jim, you used to say $10,000 an ounce. Well, that's true because it was true at the time. But when you expand the money supply, the number goes up, right? Because the amount of gold is fixed. So it was 10,000 not that many years ago, and today it's 15,000. Well, if you say gold's worth 1,800, people are going to say, well, give me the gold. I'll take all the gold you got at that price. and then they're going to have to shut the gold window again, and that has its own problems. But in other words, it's not clear how it would work. I mean, there are a lot of ways it could work mechanically. It's not clear what the government would actually do. But my point is, if you try to mark gold to market on the Fed's balance sheet, you're opening Pandora's box, because you would be getting a lot of people, bankers, analysts, Wall Streeters, investors, to sit up and take notice and say, well, hey, what is going on here? You're back in the gold business. Well, you got the price wrong, because you can't back up your money supply at that level. And the truth is you can't.